Alright, we just looked at an example where misclassifying a cost could have significant impact on the financial statements. We showed that if you classify a cost as a product cost instead of expensing it and selling it as a selling and admin expense, they can significantly increase your net income and it increases your inventory on the balance sheet at least for the current period. And that's a situation that a managerial accountant can expect to be in. They can expect to be in a situation where they're responsible for deciding whether this is a product cost or should be expensed as a selling and admin. And their decision has significant impacts on the financial statements and therefore will have impacts on other people's bonuses. And they may be pressured to go one way instead of the other. And while that's a difficult situation to be in, managerial accountants need to be prepared for stuff that's a lot worse than that. You could be put in a situation where you're expected to conduct a task that you're not qualified to conduct. You could be put in a situation where you expected to accept a bribe, where you're expected to fraudulently just forge the documents. So it could get a lot worse than just making a cost classification decision. And this video and talk about what conditions need to be in place to cause something like that to happen to cause an outright fraud to occur. And the auditing profession has come up with this thing called the fraud triangle, and it's basically something that defines the type of conditions that are necessary for fraud to occur. And the main condition is opportunity. And to understand opportunity, let's say that you're in a classroom taking an exam, and the professor um, halfway through says, "I need to go pick up my kids from school, and I'll be back in 30 minutes or so." And he leaves the classroom, and no one is around. So now there's an opportunity to cheat. There's no one monitoring the exam, and you could very easily just look onto your neighbor's exam or talk with your neighbor and increase your grade very, very easily. And that's now that there is an opportunity. Now, some people will never take advantage of that opportunity. They won't cheat no matter what their, what, oh, I mean, they're very super ethical people, I guess. There's a certain percentage of the population who are just that ethical. Um, there are other people who are going to take advantage of that opportunity, though. And there's a certain percentage of population that is like that. The majority of the population, whether or not they take advantage of that opportunity, will depend on their incentive to do so. And so let's say that this is a class where when you need a grade B on this exam to pass a class, that's pretty strong incentive, right? And you think you're on the borderline. If you look around over your neighbor's paper, you're going to guarantee you a B and guaranteeing yourself to pass. If you don't make that B, you're going to have to retake the class, or maybe you're on the borderline of getting kicked out of school. And if you don't pass this class, we're going to get kicked out of school. So you can have a very big incentive to cheat. So that incentive is really big. There's a higher likelihood, uh, because of that you're gonna take advantage of this opportunity. The other thing that's going to affect your decision to take advantage of this opportunity to cheat is whether or not you can rationalize it. Most people don't think of themselves as evil. They don't think of themselves as cheaters, but if they can rationalize it, they may take advantage of that opportunity. And the way you may rationalize this is, let's say that you start to see everyone else in the classroom cheating. Everyone's taking to each, everyone's talking to each other, everyone's cheating, and the course is graded on a curve. So by not cheating, your grades going to go down because everyone else is cheating and they're going to get better grades than you. And since it's a curve, you'll end up doing the worst. So you may rationalize it yourself, like, well, if I don't cheat, I'm gonna be penalized for not cheating. So that would be rationalization. So that will affect whether or not you take the advantage of an opportunity to cheat. So this is a simple example where when yours think about it in the classroom, I think most of you guys can understand that. But in the real world, it's the same situation. When you actually go out and get a job, there are going to be opportunities to commit fraud, and whether or not you do that would depend on whether, let's say, just the type of person that you are, or whether or what your incentive is, and whether or not you can rationalize it. And a lot of times when you get in the real world, the incentives are much more bigger. You could lose your job, you could lose your house if you can't pay your mortgage. Um, your kids are in school, so these are really, really strong incentives where it can be very hard to make the right decision. And now we're talking about running a company. We are talking about we touched on the corporate governance, where what we really mean by corporate governance is the ability to eliminate opportunities, um, opportunities to commit the fraud. That's really what the goal is. If we can eliminate the opportunity, then it doesn't matter what employees' incentive or rationalization is. No fraud is going to occur in that scenario. So, really, when we are talking about corporate governance, we want to be able to eliminate the opportunity. And to do that, you have to have a strong internal control. And internal controls are just practices that are put in place to eliminate opportunities. And that's really accompanied as really good governance has really strong internal controls. And so some examples would be like separation of duties. If you have a task, you don't have to have the same employee doing all the parts of the task. You could break up the task into different parts and separate the duties among different employees. And that way, fraud would require collusion among the employees, and therefore, it's a lot less likely. So it's a good thing to separate the duties. Other things you can do are just really common sense things like hire competent employees, hire employees with high integrity, even if you have to pay them more. Generally, it's a better idea to just get a good employee with good integrity. You can also take on the insurance on your employee, so you have an employee and you have to trust them with something very, very important, let's say. And if they are dishonest, it's going to cause you huge losses to the company. You may want to insure against that. And other examples of internal controls, just to be just things having locks on safe and protect, just keeping your things safe and protecting your assets would be a good idea in this scenario. um, it's basically like locking up your assets so that they cannot be just stolen. So basically, internal controls are just things that eliminate opportunities. So if we can eliminate opportunity, we're going to be in a lot better shape now for a long time. Um, and companies are kind of in charge of their own internal controls. They've been like that for a long time. It was up to them to set up internal controls with the company, so that there are no opportunities, or to limit the opportunities to commit fraud. But during, let's say, around 2000 2001, we had some huge accounting scandals. We had Enron, we had WorldCom, these big scandals that destroyed or crippled the company for years. And the government basically stepped in and said that, hey, we're going to require you to have strong internal controls. And and because of that, what happened is, um, they told these companies that the government would keep a check on them to make sure that there are strong internal controls. And that legislation that they passed was the the Sarbanes-Oxley Act was passed in 2002, and it did a lot of things to prevent situations like Enron or WorldCom from occurring again. One thing it did was that it required the CEO and the CFO, the two top employees of a company, to basically set up and enforce a strong set of internal controls. And the auditors had to report on the effectiveness of these internal controls in the financial statements. The CEO and the CFO also had to certify that the financial statements were correct to the best of their ability, so that they had to basically say, hey, even though we didn't prepare the financial statements, we're certifying that based on what we know, this information is correct. Sarbanes-Oxley also required companies to set up a code of ethics and report that code of ethics in their annual report. And they had to have protection for whistleblowers. They had to set up a hotline where employees of the company could call in and say, "Hey, I think there's a fraud going on here, and I and they had to protect these kind of employees. And so the employee who calls out a fraud is called a whistleblower. And Sarbanes-Oxley protected whistleblowers because in the past you could just get fired for saying things like that, like there was some kind of a fraud occurring in the company, and that's completely wrong. So basically now there's a legislation that protects people who stand up and say that something is not right in the company. So Sarbanes-Oxley was a really big act, and this really importantly, it was a really important piece of legislation. You should read up on this in your book, and you can also read up on internal controls. But since managerial accountants basically deal with all the information that a company either use internally or put out to the world, they're in a critical place where they're going to have a lot of opportunity to commit fraud. They may have strong incentives, and they may be able to rationalize it. So they have to be ethical about it.